On Friday, September 12, 2008, the most powerful bankers on Wall Street had 48 hours to save the world. They failed. For 158 years, Lehman Brothers was Wall Street royalty. They survived the Civil War, 2 World Wars, and the Great Depression. By 2007, Lehman was the 4th largest investment bank in America, employing 25,000 people and managing $680 billion in assets. Their CEO, Dick Fuld, was nicknamed the Gorilla for his aggressive deal-making and ruthless management style. Lehman's business model was simple: borrow money cheap, invest it in higher-return assets, pocket the difference. And in the early 2000s, nothing returned more than real estate. So Lehman went all in on mortgages, subprime mortgages, specifically. The riskier the better, because they paid higher interest rates. By 2006, Lehman was originating $50 billion a year in mortgages. They packaged them into complex securities, sold them to investors worldwide, and kept billions on their own books. The leverage ratio hit 44-to-1, meaning for every dollar Lehman actually owned, they borrowed $44. It was a money printing machine. Until it wasn't. In early 2007, cracks started appearing. Housing prices stopped rising. Subprime borrowers started defaulting. The mortgage securities Lehman had bet billions on were suddenly worth less than the paper they were printed on. But instead of cutting losses, Dick Fuld doubled down. While competitors like Goldman Sachs quietly sold off their mortgage exposure, Lehman bought more. Fuld believed the market would recover. He told executives to protect the franchise at all costs. The logic was simple. If Lehman admitted the mortgages were toxic, they'd have to write down billions in losses, triggering a death spiral. So they used accounting tricks, Repo 105 transactions, to temporarily move $50 billion in risky assets off their balance sheet right before quarterly reports. It wasn't illegal technically, but it was designed to deceive. To the outside world, Lehman looked solid. Inside, executives knew the truth. They were sitting on a ticking time bomb worth tens of billions in bad debt. If you want to understand how the 2008 crisis really happened, subscribe now. This gets catastrophic. By March 2008, Bear Stearns, another investment bank heavily exposed to mortgage, collapsed in 48 hours. The Federal Reserve arranged an emergency sale to JP Morgan for $2 per share. The message to Wall Street was clear: you're next. Lehman stock plunged from $60 to $30. Credit rating agencies started asking questions. Hedge funds that had traded with Lehman for decades began pulling their money out, demanding collateral, refusing to do business. It's called a run on the bank. And once it starts, it's almost impossible to stop. Dick Fuld scrambled for solutions, tried to sell stakes to Korean Development Bank, to private equity firms, to anyone with cash. Every deal fell apart when buyers looked at Lehman's books and saw the mortgage exposure. One potential investor later said, it was like opening a sewer. The deeper you went, the worse it smelled. Behind closed doors, Lehman executives begged the Treasury Department and the Federal Reserve for a bailout. But Treasury Secretary Hank Paulson, former CEO of Goldman Sachs, sent a clear message: no taxpayer money for Lehman. Find a private buyer or you're done. By September, Lehman had lost $12 billion in 3 quarters. Their stock was at $4, and time was running out. On Thursday, September 11, 2008, Lehman's stock dropped 45% in a single day. By Friday morning, the bank had hours, not days, before a total collapse. If they couldn't find a buyer by Monday, 25,000 employees would be out of work. And the global financial system would face a shock unlike anything since the Great Depression. That Friday night, the New York Federal Reserve summoned the CEOs of every major Wall Street bank to an emergency meeting at 6 p.m. The message was blunt: figure out how to save Lehman, or the entire system goes down with them. 2 potential buyers emerged: Bank of America and British bank Barclays. Both wanted the same thing: for the government to absorb Lehman's toxic assets, leaving them with the profitable parts. Paulson refused. No public money, he insisted. Saturday and Sunday became a desperate 48-hour negotiation. Bank of America's CEO Ken Lewis walked the halls of Lehman's headquarters with accountants, trying to quantify the damage. What he found was worse than anyone imagined. Lehman had $600 billion in liabilities and toxic assets that couldn't be valued. When British regulators refused to approve Barclays' purchase without UK taxpayer guarantees, the last option died. By Sunday afternoon, September 14th, it was over. Lehman Brothers would file for bankruptcy at midnight. If you're realizing how close we came to total collapse, hit that like button. Can comment. Should the government have bailed them out? At 1:45 a.m. on Monday, September 15, 2008, Lehman Brothers filed for Chapter 11 bankruptcy, the largest in American history. $639 billion in assets. Gone. Within hours, global markets went into freefall. The Dow Jones dropped 504 points, the largest point drop since 9/11's. Credit markets froze completely. Banks stopped lending to each other because no one knew who was holding toxic Lehman debt. And here's what made it catastrophic. Lehman wasn't just a bank. They were a counterparty to thousands of derivative contracts worth trillions of dollars. When they collapsed, every bank, hedge fund, and pension fund that had done business with them suddenly faced massive losses they hadn't planned for. AIG, the world's largest insurance company, had insured billions in Lehman's mortgage securities. Within 24 hours of Lehman's bankruptcy, AIG was hours from collapse. The government gave them an $85 billion emergency loan. The bailout they'd refused to give Lehman. Morgan Stanley and Goldman Sachs, the last two independent investment banks, saw their stocks crater as traders bet they'd be next. The Federal Reserve had to give them emergency status as bank holding companies just to keep them alive. By Wednesday, the entire global financial system was 72 hours from complete shutdown. ATMs would stop working. Businesses couldn't make payroll. The modern economy, built on credit and trust, was on the edge of total collapse. The numbers are almost incomprehensible. The 2008 financial crisis, triggered by Lehman's collapse, wiped out $16 trillion in household wealth in the United States alone. Unemployment hit 10%. 9 million Americans lost their homes to foreclosure. The global economy contracted by trillions. But here's who really paid. Not Dick Fuld, who walked away with over $500 million in total compensation from 2000 to 2008. Not the executives who approved the Repo 105 accounting tricks. Not the rating agencies that gave Lehman an A rating days before bankruptcy. It was the 25,000 Lehman employees who lost their jobs overnight, many losing their retirement savings held in company stock. It was the millions of ordinary people whose 401ks were cut in half. It was the small business owners who couldn't get loans for a decade afterward. The U.S. government eventually spent $700 billion on the bank bailout program TARP to prevent complete economic collapse. Taxpayers funded the rescue of the same institutions whose recklessness caused the crisis. And while banks recovered within years, families spent a decade rebuilding. Lehman's bankruptcy report, filed years later, revealed the firm had hidden over $50 billion in liabilities using accounting loopholes. Criminal charges were considered but never filed. Dick Fuld testified before Congress and was met with outrage but faced no legal consequences. Here's the part that should terrify you. Lehman Brothers didn't break the rules. They exploited them. Everything they did, the extreme leverage, the accounting tricks, the reckless mortgage bets, was technically legal under the regulatory framework of the time. The system was designed to reward short-term profits over long-term stability. And when that system broke, taxpayers paid the bill while executives kept their bonuses. 15 years later, the largest U.S. banks are even bigger than they were in 2008. Too big to fail didn't go away, it got worse. And the next time the system breaks, the cost will be even higher. If this story showed you how fragile our financial system really is, subscribe for more deep dives into the events that shaped our economy. Drop a comment. Do you think we've learned anything since 2008? Or are we heading for another crash? I'll see you in the next one.